Well, stocks wobble as investors try to shake off a slightly weaker than expected June jobs report, while the major averages head for a week of losses. So where should investors look to invest and where should they stay clear? Here to discuss, we have Freedom Capital Markets Chief Global Strategist, Jay Woods. Jay, we're going to start on where to steer clear, because that's kind of where the conversation has been going for the last few days. I'm looking at shares of Meta right now, up slightly today, but we saw huge gains yesterday on the back of the release of Threads. 30 million people downloading the app. What's not to like?
Yeah, it's amazing. The stock's up 142% year to date. Threads seems to be a hit right out of the box. There are 2 billion subscribers on Instagram that can easily switch over to it. But I don't know if you got to check it out. I wasn't really impressed. I don't know if that's going to last, if it has the momentum. It is a great story, but I like to look at the price action in the stock. We've come pretty far, pretty fast. It was beaten down last year. It filled a major gap to the downside from Q1 2022, and it looks like it's tiring. There are a few things I'm seeing in price action that tell me it may be time to pause and it may retreat from here.
What would be a comfortable entry point for you when it comes to Meta? I mean, you could certainly argue that, look, maybe Threads didn't blow everybody out of the water, but it feels really opportunistic when you think about where Twitter has struggled if Meta hadn't seen such a run-up going into the launch.
Yeah, you know, this could be one of those buy the rumor, sell the news kind of events. For me, I think a natural pullback is in order for a stock like Meta, given the run-up we've had. It's so far above all its major moving averages. A 10% correction, which would put it down around 260, would come right back in line to a 50-day moving average. It hasn't touched it in well over 8 months. These are levels where I could see a natural pullback and the stock's still in a majorly uptrend. And then you talk about rotation in this market. Here's a sector that's been hot. I'm watching the 10s and the 2s. If the 10-year stays above 4%, if the 2s stay above 5%, and they're borderline right now, and they gain momentum, they break out to 50 yearly highs, that could draw people away from these magnificent 7 stocks and put stock to work in other defensive sectors.
Okay, another stock you say to stay away from, Starbucks. 2 key issues you've pointed out here: commodity prices and a potential pullback in consumer spending. What's your concern?
Yeah, my concern is twofold. One, we're talking about consumer spending habits going forward and the student debt coming back into play September, October. And I've had conversations with my Gen X kids, people that go to Starbucks regularly. What's going to get hurt? Consumer discretionary. Where is an easy place to cut? It's Starbucks. And then if you look at another headwind, you look at the commodity price of coffee itself. It had a nice little reversal the other day. Prices are starting to go back up. That could hurt margins going forward. Do they want to raise prices if coffee commodity prices go higher in this environment? I don't think so. And then more importantly, I look at the technicals. I look at the price action, and it's got me a little concerned.
Let's talk about the positives here, some of the stocks that you like. Generac, specific one that you've highlighted here. We spoke with the CEO of Generac earlier today on major temperature shifts and its ripple effect. Take a listen.
The last 2 decades, you could argue, we've really seen a lot more outages, and a lot of outages are driven by weather. I think what's changed here more recently, and as we think forward here and as we look to the future, is the extreme temperature swings. Those types of extremities in terms of temperature swings are really having a major effect, frankly, on the stability of the grid. And this is really a broader discussion of the evolution of the grid as we work to decarbonize the sources.
So Generac CEO, they're saying that, look, some of the temperature or just climate impact is a positive for Generac. Is that the reason for you getting in on this stock? What are some of the other potential drivers?
There are 2 reasons. 2 reasons. One, spot on. I mean, the hottest day in the history of the Earth in the last 2 days. But I look domestically, I look at the outages we've had in Texas, and that caused people to go out and buy Generac generators. They need to power their houses. And then also, it's hurricane season. I don't know if you got to go to the ocean this last week. Here on the East Coast, the temperatures are really hot for this time of year. That's not good for people concerned about storms brewing as we get later on into the season, August, September. So historically, Generac has done well in strong hurricane season, and unfortunately, that's something we're looking at. And then price action, wow. This was the worst performing stock in the S&P 500 last year. It has a lot to reverse. First, what did it do? It broke a long-term downtrend of about a year. It stopped going lower, one. It started basing going sideways, making constructive higher lows along the way. And then what happened? In May, after its quarterly report, it gapped higher, broke out of that major downtrend above key moving averages, and it's starting to make its way higher. It has a lot to reverse. Yes, it's been having a good year to date, but it has some resistance at the 150 level. It just flagged, gave investors a nice entry point over the last few days. But I think this stock goes back to 150, and seeing where it's come from, I don't think 200 is too far out of the cards either.
Finally, Jay, a sector play here, specifically what you like, industrials. What's the upside there?
The upside is great. This is a sector that if you look at it on 2 time frames, when I look at charts, I look at multiple time frames. On the daily chart, it just made 52-week highs. It broke above this level, 103, 105. This is constructive price action. And let's back out. Where is it coming from? It's been in a base where it's failed to get above 105 several times now, going back almost 2 years. It's above there right now, 107. It got above there, it flagged, it tested the old resistance level, which hopefully is now support. Other thing I see, MACD crossovers. I don't know if we have a chart of the MACD crossovers on a weekly basis, but in the last 5 years on a weekly chart, we've had 6 positive crossovers. We just had a 6th a few days ago. Every single time, the index has gone up a minimum of 8%. So based on the 103 level where we saw that MACD crossover a few weeks back, it looks like it has a lot to run. It melt 112, 115 easily. Plus, it broke out, so it's got a lot of momentum. And they say the longer the base, the higher the space. And I believe that as we rotate out of some of the mega caps, industrials is a sector I like. The stocks leading the way, the GEs, the Lockheed Martins, and Northrops. Watch Boeing. Boeing's about to go as well. If Boeing goes, the sector goes higher.
A lot of investors looking to move out of tech. Taking note there. Jay Woods, appreciate your time today. Thanks so much for joining us.
Thank you.